All right. Good morning, everybody. Welcome back. Hope y'all had a good weekend. So the drama continues this week. It looks like the United States is now going to be the one who attempts to close the Hormuz Strait, adding to the global energy crisis that's happening. And that is going to be front and center above and beyond anything else, right? Those headlines, anything connected to the energy crisis is going to dominate. This week, we've got earnings starting. We've got an economic calendar tomorrow, PPI. And on Friday, we will run OpEx, which is options expiration, right? It always happens on the third Friday of the month, something you can always plan for. Tax day is this week as well. It lands on the VIX expiration day. VIX expiration is likely to be a little bit more trouble than we would expect at first blush. We might dig into that a little bit more tomorrow. Um, it's going to happen on Wednesday, and then we're going to get some job numbers on Thursday. So, kind of a busy week, all things considered. As you would expect with news on the energy front, we're right around the world. Japan is basically flat at the moment, but they're they're going to really feel this energy problem. So not sure why they're even green at this point, but they're basically flat and everything else is red. That's what we're going to be watching through the morning, crude and VIX, to see if we're going to get a change in behavior. And we do have some auctions today in the front end. You can see the 3-month and the 6-month. Those really aren't the auctions that tend to move the markets. Never hurts to keep your eye on them. I would never ignore data, but those don't generally give us any problems. It's possible that today turns into a hurry up and wait situation for tomorrow's data, but it's also possible we just spend the day reacting to headlines. So just really not quite sure how we're going to play this. But tomorrow, PPI, everything that we talked about last week with the liquidity gap and the possible outcome of those, we're going to have that opportunity again tomorrow morning, which is why we have the potential today to just go sideways in front of that big data print. I continue to listen for anything about some sort of JGB intervention with Japan, and I mean their tenure is getting out of control, and they've done some saber rattling, but they haven't pulled the trigger and intervened yet. But it's worth keeping your eye on that 10-year JGB too. If you go to the Fed Watch, that thing is all over the place. The markets don't know what to do if they need to price in rate hikes or uh, price in rate cuts. So they're throwing a little bit on each side, really just not knowing what to expect. They're not high enough to show any conviction either way, but just seeing this highlights how the market has no idea, right? And we're talking about institutions that can hire, a team of researchers to try to figure out what's going on in the market. They always talk about smart money as if retail is dumb, and really it's about how much man hours and how much manpower you can throw at a problem to try to find a solution. And these funds and firms can hire a whole team to perform research and get answers. And right now, they don't have it figured out any more than you do, any more than I do. So if you're having a hard time with your swing trades and figuring out where the market's going to be in 6 weeks, 2 months, so's everybody else. All right, this is CTA positioning. You can see it started to flatten out a little bit going into the end of the week last week. It's very likely that by Tuesday or Wednesday, we will see this pointed lower again. This is not a real time thing, right? You can see the timestamp is from Friday. So when it updates, we'll see it. The main thing is it wasn't headed back up sharply, right? At best, it was just flattening out a little bit. And the VC funds. Now these guys non-discretionary completely. They don't have a say in it, right? They're not going to buy or sell because they think they see something. It's not about technical analysis or trusting their gut or seeing a setup or a pattern or a signal. They buy and they sell based on what the volatility is. And they have no say in it. If the VIX gets below a certain level, they have to buy, and if it gets above a certain level, they have to sell. And that's it. That's just the way it goes for them. So we triggered that level. They did a little bit of buying. It's very likely that they're going to just turn right around and start selling again. Got to keep our eye on the VIX and what's going on in that direction. But the main thing is it's still down. There's no change in that at all. This little bump is nothing. Could be that it's just like this one or this one. We just don't know yet, right? For right now, White House risk is really low. It's at 10. And it doesn't look like anything is on his schedule that could cause any real volatility. So White House risk seems light at this point. If that changes, I'll give you guys a heads up. I mean, I don't just sit staring at this all day, but we'd see something coming through the headlines. All right, 89,000 in the overnight shows their participation. They're not sitting it out, which makes sense because somebody had to run it back up. But we didn't get that gap closed. still a gap that needs to be resolved. All right, you can see the volatility trigger is 68.25. We are still above the zero gamma line, which is 67.65. We got the 10-week and the 10-day moving average, 20-day, 200-day, all below us. And way down here, 65.40 is the put wall. So we're not going to get any help with them monetizing the puts and trying to run us back up, because looking at it from this perspective, you can see that it's a long ways off. Now to the upside, we got the call wall, 69.40. We would need a breakout of last week's high and a continuation to the upside to get there. It's about 130 points away. Now, last week, when we started the week and we were back here, I was talking about how we didn't know if this was going to be a lower high from our continuation lower and that we would fall down, or if we were going to keep going up and break this level that needed to be broke and end up putting in a higher high. And we did, right? We broke that level, and we put in this higher high. Now we've got to figure out where our higher low is, right? We've got the low down here, and we've got nothing. We don't have a pullback yet that leaves with a pivot to give us anything down here. But we are looking for that higher low. So that's what we want to be focused on, is where is that higher low going to come in? Well, Thinkorswim's just a little laggy today, huh? Maybe it didn't get its coffee. Call it 66.11 cog line. The midpoint of this run is a level that we really need to stay above. That's a good starting point. 6600, 6611. I don't think it would matter all that much either way. Just do whichever one suits you. $786 needs to hold, or we're going to take it back to that mid. Now, if we can hold this 786, we have another chance at 88. And of course, if we get through that, then we can challenge 69.50 and 70.11 cog line. But we got to get there first, right? Now, this red candle this morning is hollow because I'm using trend candles, right? Typically, my red candles are solid. That shows that price opened and then fell and closed lower than where it opened and closed lower than the previous day's close. It's pretty obvious. When it's hollow, it's showing that the current close is lower than the previous day's close, which is why it's red, but it's higher than where we opened. So it's still red because the close is lower than yesterday, but since it opened, it went up, not down. So far, we're holding that 786. Yeah, it's in your settings, right? style, candle trend, candle trend, Heiken Ashi, candle trend. So that's what we're working with right now, and that's what we want to see. If this becomes our high or low, then all good. We'll flip it around, run it back up to 100, continue this move to the upside, and it would just be a part of a whole continuation process. Otherwise, we break that 786, come back down, and then it's a big question mark whether we even hold at the half or not, and then get the bounce, or we just break that half and keep on coming. All right, we got close to the ADR half this morning, but it's worth having this discussion. These lines on this platform show up based on where we opened at 6 o'clock. And that makes sense and it's helpful because if we used them from where we closed on Friday, then we very likely would have already hit the lower ADR at this point, right? And we would have rallied up off of that lower ADR. So depending on what platform you're using these ADR lines, if it's using the close, then we've already hit the lower ADR, likely, and we've moved up off of that. Otherwise, now we've got this gap, and we have the lines that were applied Sunday night, and we haven't hit the line yet. Typically, we would say if we get to one edge early enough in the day, we can go to the other edge by the end of the day. But we didn't get it. We're not there yet. The longer it takes for us to get to that line, the less likely it is we'll make it to the other side by the end of the day. So if we're going to get it done, we need to just get on in there and get it done. If the market's going to go into a hurry up and wait mode for tomorrow's PPI, then it's very likely we have our range for today already set. And that would mean the low is in, and we either A, stay inside of this Globex range for the rest of the day, or B, that we climb back up and we stay within the Globex and or Friday's range for the rest of the day. Base case argument, we sit inside of this and we wait for data. At this point, that's not really very helpful, right? Focus on what we've got. Within the Globex mid, we've got the half 6,800. Underneath that, we run it back down to the low. Then we can begin to expand to the downside below that. So the mid of the Globex range needs to hold, or we're aiming for the bottom down here. Now there's a little bit of a speed bump along the way. The Globex opened, but it shouldn't be too much of a problem. 68.7, 67.80. All right, today's floor pivot higher than yesterday. That's bullish. Price opened underneath it. That's bearish. We had 3 MDPs in a row. Wednesday, Thursday, Friday, we never hit the floor pivot. It's really bullish to be able to say that. But of course, we lost all of that with a headline and this big gap that isn't resolved yet. Now, because of that move, our floor pivot is still way up here. That's not helpful. It's a very narrow channel. Narrow channels imply if we break out that we keep the breakout. So far, that's holding. We have broke out and we kept it for now. We gapped down onto the weekly floor pivot. Last week's floor pivot is way down here. This week it's here. So a bit of a move up. And it's what we landed on Sunday night. So 67.73, kind of need to hold the line there. Don't want to give that up. As long as we're above the weekly, we're still considered in a bullish backdrop. And of course, if we get underneath that, we're going to have a bearish bias. If we can get out of this weekly channel, 68.18, we'll take another run at this floor pivot, 68.65. So right now we're trying to get back through S2 from underneath it. It's kind of a rare thing. We don't normally have it like that. So that's what we need to get through. We can get through S2, then we can target S1, get through that, target the floor pivot. Otherwise, coming back down and cutting below S3, well, there's really not much down there, right? Other than the floor pivot, the Globex low, and then it's just game on to the downside. 67.27 is the other edge of the weekly range. You can see the range up here seemed to have some impact with price, so might expect a bit of the same in the other direction if we go to the other side. Same as the channel had some impact on price back here. Get the idea. It's a level to keep on your radar. Now, Friday's range wasn't really big, right? It's kind of a tight range. And that shrunk our S&R lines for today. It's a pretty narrow range. It's one of the reasons we was able to get to S3 so easy. I mean, yeah, we had a big gap, but we also had a narrow Friday, which tightened up our range. Again, this kind of reinforces the idea that we just end up sitting here in our own Globex range and we run it through the day today. Maybe poking out a little higher or poking out a little lower, but just kind of holding steady into the close, focusing on tomorrow's PPI. Headlines will throw that right in the trash, and goodness knows where we'll go. But without those headlines, we very likely are just going to sit here and churn. We don't have much to work with here yet for this week, but you can see where the point of control is, 6811 cog line, and it's lining up with this really large footprint that we put in last week. If we continue that drive to the upside, we have last week's point of control over our head that we're going to have to deal with. So if we do break out of our Globex high and make a run for it to the upside, 68.62 is last week's point of control. Watch that level. It's likely going to be difficult to get through. To the downside, we had this point of control from the March OpEx. We basically landed on it Sunday night, and we've been trying to hold above it since then. So that Globex low that we're focused on, it's got a lot of structure behind it. That OpEx was a triple witching OpEx. A lot of structure there. Otherwise, if we lose that level, we drop below our own Globex low and we cut 67.50, 66.50 is where we're headed. Remember, we're running 50s. There's not a lot of footprints to help us out. Just a big, wide gulf. Nothing in there to help us. So shopping around for some really cheap options down there, if you can find any, wouldn't necessarily be a bad idea. Just remember they're YOLOs, right? They're just scratch lottos. So keep them really cheap and expect that they lose. And if you don't like that, don't put it on. It's not a high probability trade or a high conviction trade. It's literally a gas station lottery ticket trade, a 1 in a million kind of chance. Better than a million odd, but still a low probability trade. Those low probability trades pay really well when they hit, but they lose most of the time. $10-day, 30-minute volume profile and TPO. We really don't have anything up here. This just reinforces how much 67.50 needs to hold, or we're going to retrace 66.50. We got the 10-day point of control at 66.22. And if we're going to move that level, it'll be because we hang out right where we're at and we're able to build out this footprint. It's possible that we make a run and get up into Friday's level today, right? Break our Globex high, get back up there and build this level out. One of those two. So it's possible to bring that line up. But if we are going to sit sideways in front of CPI, I would expect a lighter volume trading day, and a lack of participation kind of implies we're not going to be able to fill this footprint out enough to move that point of control up yet. We got a new VPOC from Friday. I'm just going to get it to the point close enough. If you guys want to zoom in on it and get it to the tick, well, you do you. So if we break to the upside and get through our own Globex range, get into Friday's price by breaking Friday's low, then you can challenge that April 10 VPOC. It's at 68.56. All right, on Friday we looked at this range and it didn't really stand out that much. But now that the week is closed, we can compare it with last week, and we can see that this week's range is narrower than last week's range. A narrow range implies a lower volatility, but of course that has to come with some meaning behind it. Economic events that are on the calendar can create a low vol environment. right? CPI, PPI, non-farm payrolls, those things suppress volatility and give us a narrower range. It's a false sense of smaller volatility, right? Because the volatility is a nerd word for movement. And if you look at the price action in the ES and the NASDAQ, we're making big moves on a day-to-day basis. Not necessarily last Friday, but in general, we're getting bigger bars. We've got a larger ADR. The day-to-day price action is just bigger, right? We're getting larger swings. So we have volatility. So why is this indicator suggesting that we have a low volatility for this week? It's because it's reading the implied vol on the options that built up this week's range. So the market makers and those that are trading on the weekly expected move are anticipating that this week is going to be a sideways week because of some economic data. That's what will give us a narrower range. We see this on FOMC weeks and CPI and PPI and that sort of stuff. So don't let the narrow range fool you. There's still a lot of volatility out there. And there is the potential for some very large moves because of that volatility. This narrow range is just telling us that the market is concerned with something on the economic calendar. And they're pricing in that whatever it is, it likely causes us to go sideways and wait on that data. Just like how we'll go sideways on Tuesday before an FOMC day on Wednesday. So maybe it's OpEx. Maybe they're worried about the VIX expiration on Wednesday. Maybe they're worried about PPI tomorrow. Whatever it is that's on the calendar, the market is pricing in that we likely go sideways and wait on that data. Now, once we get the data, well, buckle up, Buttercup. We are 1% above the 10-day moving average. It's not a bad place to be. We backed off from that 2.0 level that we were at last week. So this is a good spot to be. We're not overextended. We're not wildly bullish. We haven't moved too far too fast, and it doesn't owe us anything at this point. It's just a good steady place to be. Thing is, we need to keep it. So if we continue to move to the downside, watch that 10-day. If we get within 0.5% of it, we can start to gravitate to it. We are 1% above the 10-week. It's not a bad place to be. We were more than 2%, kind of backed that off a little bit. Remember, these moving averages, they move with us, right? The daily moves every day, the weekly moves every week, and the weekly moved. So whatever we had outrun, it just took a step and got caught right back up with us. Same thing applies here. If we continue the move to the downside, keep your eye on that 10-week. If we get near it, we'll likely gravitate into it. The weekly expected move low is basically 67.50. Now that's not to the tick perfect, but it's close enough. It's like 67.48. 2 points, close enough, 67.50. Now we've got a 70% chance of closing inside this box on Friday, because this box is a 1 standard deviation. Math says 68 point blah 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 chance that we land in the box. That's 7 out of 10 times we would close on Friday inside this box. We did not close inside the box last week. right? We blew out of that box on Wednesday, and then Thursday and Friday we kept it. We never went back and got inside the box. That was the first time in a little while, right? We had another breakout that ended at the end of the week here. And then this one, that's 3 in a row. But before that, it's been a long time since we broke the box and held that breakout into a Friday close. The thing about counting these boxes and counting how often we're closing outside of them on Friday is to keep track of the error rate, right? Standard deviation, just like anything else, works when you have a high number of probabilities, right? Or a high number of occurrences. If you throw your bowling ball one time, you don't have a bowling average, right? You have to keep continuing to throw the ball over and over and over and over again for you to even begin to develop an average. And then the average will be more accurate the more you throw the ball. So when we look back at this count rate and we just use 7 out of 10, well, that's just because I don't want to count back 52 weeks a year for 5 years trying to figure out how often we closed outside that box. When times are good, we tend to close inside the box more often, right? We're on the 7 side when times are good. When times aren't good, we're on the 3 side, the side that says we're going to close outside the box more often. So, repeated, consistent, consecutive breaks of the box Friday after Friday after Friday, we're breaking the box. Tells us, A, we've got a lot of volatility being mispriced. It's not getting into the market dynamics. And that the market width is nowhere close to being accurate. Our range is too narrow for the amount of risk that's being priced into the market. So if you're looking at options and you're thinking that they look pretty juicy and that you want to sell them, this is saying that the juice ain't worth the squeeze. The amount of money you're getting in credit doesn't cover the amount of risk you're going to have to take because markets are still making outsized moves. And there ain't enough credit. You can't get far enough away to not get hit. Looking at what's down this morning, Bitcoin, China, airlines, junior miners, regular miners, gold, chips, Mag 7, uranium, tech, banks, quantum, growth, cloud, everything is down this morning. Metals and mining, industrials, communications, everything. Shorter list would be what's up this morning. What's energy, XLE, XOP, that's it. Energy. So just like last week and the week before, we don't want to focus a lot of our effort on monitoring market breadth because market breadth is not going to move the market right now. If the Mag 7 all turned bullish and tried to rip to the upside today, I don't think it would move the markets very much at all. The markets are being bullied by crude and the VIX. Throw in some treasuries if you want. That's what's keeping the market and what's moving the market. So you, of course, keep your eye on the market breadth. Look at the various sectors that are out there, see what's moving. But I wouldn't expect to see any influence from the broader market and its participation. Even 0-day flows and dealer positioning are going to have to take a back seat to the VIX and crude. We got it pretty easy, all things considered. It's a decent range. It's nice and clean. And the upper edge is a cog line. We'll take what we can get. So you got to get out of this box if you're going to get anything else done. Break that cog line or the Globex high. Challenge Friday's low. Get inside of that. Get to Friday's close, which is very likely close to Friday's mid. Then challenge Friday's high and then continue on to the upside. And that's if we can get that breakout to the upside. Otherwise, we want to focus on our Globex mid and whether or not we're able to hold above that 6,800. If we fail that, aim for the low, and from there we just expand our drawings to the downside and play it level by level. Right on down we go. So, like I said, pretty fair setup, all things considered. I'll take it. We've certainly had worse than this. GTFO, all you got to do is get out of the box. That's what I got for you guys. Be careful, be safe. Keep your eye on the clock. I'll see y'all tomorrow.
Recording stopped.